This does not feel the back end of a shortened trading week at all, does it? We're down every single day this week so far. 3-day losing streak on the S&P 500. We're trying to bounce here, trying to snap that losing streak, up a third of 1% on the S&P, and Nasdaq 100 up 0.6 of 1%. The opening bell rings. Switch on the board and get to the bond market. Yields look a little something like this on a 10-year. Higher this morning by 7 basis points to 3.46 in the FX market. Euro dollar negative 0.2 of 1% at 108.14. I have to say President Lagarde sounded a whole lot like Vice Chair Brainerd. Staying the course is my mantra for policy. 24 hours after hearing Vice Chair Brainerd say we're determined to stay the course. Crude earlier had a look at 81, back down to about $80.72 on WTI. We're positive there, a half of 1%. About 20 seconds into the session, equities look like this on the S&P 500, positive a third on the Nasdaq, up 0.6 of 1%. One stock to watch at the open, Netflix, absolutely crushing subscriber estimates with more than 7 million additions in the fourth quarter, plus a big change in the C-suite. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, John. We're up around 6% on the stock, biggest jump since November. I'd love to say that, you know, the street, the analysts and all the investors are kind of digging deep into what the Reed Hastings move upstairs means, but I think they're probably zeroed in on the subscriber beat for the last 3 months of 2022. 7.7 million subscribers added above the estimate of 4.5 million, which also Netflix was guiding to. There was some limited discussion on the call and in the earnings statement about the impact of the ad-supported tier. Netflix said that they were seeing progress in it, and actually there is some evidence that cost-conscious consumers were lured in by the ad-supported tier, which could have been of benefit or additive to that 7.7 new subscribers add. And a lot of the sell-siders who are responding positively this morning flagged that. On the change-up, look, Greg Peters moves from COO to co-CEO. He has already been the face and leader of this ad-supported tier move. He has been the guy that's also been cracking down on password sharing, something that Netflix has been discussing and will now start charging for password sharing, which could be supportive for revenues this year, according to the street. Otherwise, Reed Hastings remains in the executive chair role. Ted Sarandos already really focuses on Hollywood, really focuses on content, but there was another promotion in Bella Bajaria, who jumps from global head of TV to chief content officer. Overall, given a lot of the challenges this industry is facing, Netflix seems well positioned, and they pledge to get their profitability sorted in 2023.
Ed, why is it so difficult to guess subs? The difference between the number and the estimate is like this wide, off the screen wide.
Yes. I don't want to get myself in trouble, Jonathan, but I'm pretty sure that Netflix guided quite conservatively. They have a history of guiding quite conservatively.
Sure.
And remember, they're going to suspend guidance going forward anyway. I think what was interesting from the earnings call is we're not going to get a number going forward anymore, right, which will do away with this whole problem. But they did give some sort of commentary around how actually first quarter will be a little bit softer than fourth quarter of 22. Second quarter might start to see improvements, etc. So we're not going to get that full forecast, but we will get a few clues as to what's going on. And either way, they seem committed to content. They seem committed to growth globally, and not just here in North America, but think about Latin America, Asia Pacific as well.
Ed, thank you. Stock's up about 5 or 6% in early trading, 3 minutes into the session. For those of you with a Bloomberg, pull up Netflix and then just quickly type ERN, go, and it will give you the surprise screen for earnings for Netflix. If you don't have access, I can just show you what I see. If you look at the price change after earnings, so up about 6% right now. The previous 4 earnings releases, the stock was up 13, up 7, down 35, and down about 22%. So that gives you an idea of how wild post-earnings Netflix price action turns out to be. Another day and another round of layoffs we need to discuss. Google announcing plans to cut 6% of its global workforce, roughly 12,000 jobs. In an email to his employees, the CEO, echoing many of his tech counterparts, writing the following: I take full responsibility for the decisions that led us here. Kelly Lyons, how many times have we heard that over the last few months?
So many, John. Alphabet is just the latest in a long list of tech companies announcing that they are pulling back on their workforce after expanding it so rapidly over the last several years over the course of the pandemic. Of course, that was boom times for big tech. We are not living in boom times anymore, which is why Alphabet is announcing the 6% cut, as you mentioned. That affects globally their workforce across all different segments of its business. Those laid off here in the U.S. will get at least 16-week severance as well as health care benefits for 6 months. But really, this is about the weaker macroeconomic environment that Alphabet is facing. It has dealt with the slowdown in its digital advertising business as well as its cloud computing division that is still behind Amazon and Microsoft, and its sales growth has been slowing for 5 consecutive quarters. It was just 6% last quarter. And of course, we're going to get the latest figures from the company when it reports on February 2nd. Our analysts here at Bloomberg Intelligence do say that the layoffs announced today could help offset some of the headwinds the company is facing and aid operating profit this year, help drive faster profitability in its cloud business especially, which is where the bulk of the headcount growth over the last 2 years came from. But Alphabet, as we started talking about, John, is not unique in this and trying to rein in costs as the economic winds have shifted. This is a familiar story that we've already heard just this week. Microsoft cutting 5% of its workforce, an announcement just days ago. Amazon began laying off 18,000 people. Salesforce, Twitter, Meta, the list goes on. All of these companies recalibrating their cost base because the reality just looks very different than what they've experienced over the last several years, John.
The stock right now up 2.6%. It's a major change, Kayleigh. Thank you. The C-suite in Silicon Valley taking full responsibility for the recent tech austerity. Salesforce CEO Mark Benioff has said this: we hired too many people. I take responsibility for that. We heard this from Google's leader. We hired for a different economic reality. I take full responsibility. Amazon, we've hired rapidly over the last several years. The CEOs owning their missteps, bracing for a bit of a slowdown. Mandeep Singh of Bloomberg Intelligence joins us right now. Mandeep, you and I had this conversation earlier this morning. Let's explore it further. What is this new era? We've talked about the end of an era. What's this one?
Well, first of all, we're going to look back at this post-pandemic period, and really, I think the way these companies hire their, employees in terms of expanding their employee headcount, this is going to go down as one of those phases where really these companies, I think, acted to an extent irresponsibly in terms of expanding their footprint. Yes, you can expect a lot of leverage from these businesses, but companies of this size, growing employee headcount 20, 30% every year, this is an anomaly, and we're not going to see this again anytime soon. But look, I think in terms of right-sizing the business, this is just a first round of layoffs. Guess what? If you're going to see competitive pressure on some of these companies, and I'm not saying it's going to happen to every large tech companies, but some of these companies may have to do an additional round of layoff if they find themselves to be in a weak competitive position going forward.
Mandeep, what kind of time frame are you thinking about?
Well, so again, no one knows the extent of this downturn. There is a cyclical element to it. My sense is, the digital ad companies, especially I think Alphabet is in a strong position still. The revenue base is diversified, and they have to fix the cloud profitability, which I think they're trying to do here. Meta, nobody knows what the outlook is going to be going forward, for just the way it was growing before. Can it keep growing? I don't think so, because they're losing, impressions and time spent on their platform. And that is where, yes, they have done a 13% layoff, but guess what? It may not be enough, because it's not going to fix all their profitability issues. And, right now they're investing in Reality Labs, which is 2% of their revenue, but makes up 20% of their headcount. Same thing for Alphabet. Cloud is like 10% of their revenue, 30% of their headcount. At some point, they will have to right-size all these segments that are not making money.
Huge cuts, austerity hitting Silicon Valley in a major way. Mandeep Singh, Mandeep, love it. Great to catch up, as always. Bank of America's Jared Woodard looking for opportunities outside of big tech. He wrote the following: we see more risk ahead for these $70 trillion of tech growth and debt assets that proliferated over the last 20 years. We favor equally weighted equity indexes over market cap weighted indexes and favor small cap value stocks versus large cap growth. Jared Woodard, I'm pleased to say, joins us right now. And Jared, you also prefer the rest of the world over the United States. So can we start there? Why the rest of the world?
Well, John, when you think about the big equity indexes, you think about where they're concentrated and what the big risks are that they face in a world of higher interest rates, potentially higher trend inflation, big macro pressures. That's not a world in which very expensive growth stocks tend to thrive. And unfortunately, that's still the best way to describe the S&P 500. The rest of the world is exposed to other things, other risks, but not the kinds of risks that we think are going to be as urgent this year. And so whether it's emerging markets, especially outside of China, from a financial investment point of view. Even Europe, even Japan face some meaningful risks, but they don't have the kind of valuation pressure that is still, I think, a big headwind for large cap U.S. equities.
Jared, 3 words, outside of China. I heard those 3 words louder than anything else you said. Jared, we've come into a new year. China's ripped. Everyone's getting on board. And you just said outside of China. Jared, why is that?
I think that the most important message is that you can have exposure to the Chinese economy and to the benefits of Chinese economic reopening without already owning Chinese financial assets. I think this is especially important for dollar denominated and U.S.-based investors. Of course, you want to have exposure to the world's largest economies and to those benefits, but it doesn't have to be within Chinese financial markets, because look, a lot of the risk factors that were on people's minds so much in 2021 and even last year around accounting and transparency, good governance, never mind some of the other risks that people have known about for years, these are still live issues that haven't been resolved. You see bipartisan now support for a kind of a disentangling, both on technology and even wider economic applications between the United States and China. And so I think it's worth having exposure, but doing it in parts of the world that benefit in a major way, but without the same risks.
2 obvious places to look. One's EM, the other's Europe. Can we talk about Europe? Europe has ripped so hard off the lows of last year, and it's had a tidy rally as well to start the year too. Can we talk about Europe and whether it's just lucky with the weather and it's a trade, or whether there's something here a little bit longer term?
I think it's a tactically, even for 2023, a good trade. For the longer term, the same issues around, plunging, adverse demographics, lackluster productivity, the absence really of the kind of technology that can be transformative. Some of the big risks structurally haven't been resolved in Europe, haven't been resolved in Japan, and so I think you have to be nimble.
They're victims of bad energy policy. Most people would say that. Jared, bad energy policy has been good for energy equities over the last couple of years. And Jared, you haven't given up on that trade. Why is that?
Look, think about this image. It was in the press a lot last year of that wind farm in Germany that had to be destroyed because they needed to get access to the coal underneath. Okay, the fact remains that you have to walk before you can run, and unfortunately, it looks like some parts of the world have made big investments in the interest of running from an energy policy point of view, but without secure resources to get them to that future. In the sectors that make it possible, whether it's oil and gas or I think nuclear power or midstream service companies, there's a lot of places to invest these days. But we think that natural resources, doesn't matter what your politics are or what your policy preferences, you're going to need copious quantities of raw materials, mine and otherwise, to make the future happen, whether you're on the left, right, or center. And those things are still undervalued in the marketplace today. Look, energy and materials, throw in some industrials, and you had basically half of the equity market for much of the 20th century. Today, those sectors account for like 10 to 15% of equities. And we think that there's some mean reversion from a structural point of view higher that has to happen. You have to recapitalize those sectors if you're going to have an efficient, productive economy.
Hey, Jared, this was thoughtful stuff. I appreciate it. Jared Woodard there of Bank of America. We are about 12 or 13 minutes into the session. Equities are positive 0.2%. I mentioned EM, emerging market assets recording their best start to the year since the 1990s.
I think China is quite pivotal. So that's the one we're watching. That's what we're focused on this year, that will allow EM to possibly outperform developed markets.
A conversation you do not want to miss coming up next with Robert Koenigsberger of Gramercy Funds.
Emerging markets.
Emerging markets.
Long emerging markets.
The U.S. is not the only market in the world.
We're in the start of a dollar downtrend.
The emerging markets benefit from the weaker dollar.
China is quite pivotal.
Emerging markets assets are cheap, right? They had a very bad year last year.
There are some juicy yields to be had.
And they offer carry.
There's a great confidence around the outlook now.
You kind of can't fight that carry.
Emerging markets kicking off the year strong. Sovereign bond sales seeing the best start in a decade. A weaker dollar, China's reopening fueling demand as borrowers welcome the lower costs. Gramercy Funds calling for significant upside in the next 12 to 24 months. The firm remaining constructive in its Q1 outlook, expecting the destination to be worth the volatility. I'm very pleased to say that joining us now is Gramercy's Robert Koenigsberger. Robert, great to catch up with you, sir. It's been a while. A lot of people are outside of this trade wondering if they should chase it. You're in it already and have been riding this wave for the long time. So let's start there. You've got a different decision to make. Do you stay in it? If you choose to trim some of the winners, how do you redeploy that capital?
That's right. Good morning, and thanks for having me again today. So look, I think there's a tension between FOMO, fear of missing out, and also climbing the wall of worry. And, I think we got to go back and look historically at the dislocations that we've seen in emerging markets and see some of the returns that have come out of those. And, over the last 25 years, we've had like 11 of them. The peak to trough is down like 20%. The recovery takes about 8 months, and it's typically been like 27%. And then 12 to 24 months over that, after that, you see very strong returns, like 30 to 50%. So from a historical perspective, I think it's hard to stay out here. Now, one of the themes that we vetted in our top down this year is volatility. And, we expect there'll be volatility due to liquidity, due to policy uncertainty, due to supply and what have you. So that's where, Jonathan, we've talked in the past about having the ability to be tactical and to be able to move around, not only from a top-down perspective, but from a bottoms-up perspective.
Can we factor in China as well, Robert, just to jump in? Because China's reopening story has poured gasoline on all of this as well. Can you tell me about how you think the characteristics of China's reopening might be different to what we experienced in the West and what that tells you about where you want to be off the back of this?
Sure. I think, and I think we talked about China in the past. A lot of the focus was around the property sector, and the property sector, I mentioned it because it's like 25% of the GDP. And I think a lot of the concerns around China and what they may or may not do in 23 were perhaps alleviated a bit in the fourth quarter of 22, when I think they acquiesced, they blinked. The support program that's gone to the property sector to support the economy gives you a sense that that China, the China sovereign is behind it. I'm still of the camp that, there's still a lot of pent-up demand to get outside of China, to travel and what have you. So I think we're going to see tailwinds from China in the reversal of COVID.
Let's say you were smart, like you guys were, and you picked up the debt of a Chinese developer at 7-8 cents on the dollar, and that's back to about 70. Robert, do you stick with that?
Yeah, that's a great question. And so it's a perfect example, Jonathan, of being able to be dynamic. So for us, we picked about 4 different baskets of Chinese property developers. The first one you mentioned, if you take something like Country Garden, it was trading around 7 or 8 cents. It is trading around 70. The asymmetry has gone the other direction. But interestingly, the second tier, third tier companies that are going to restructure, and part of what kind of announced in the fourth quarter is kind of the green light to restructure, they're still trading at like 10 and 20 cents. So, that's the opportunity to be dynamic, to move from the 70-cent security down to the 13-cent security, if you will.
You said they blinked. Can we just build on that? Because it's only a year or so ago people said China was uninvestable. Why do you think they've blinked? Why are you so convinced that this is a policy shift that is sustainable?
Yeah, and I'm not going to say that broadly about, Chinese investing, and I agree with your previous guest that, you don't always have to get exposure to China through the local market. But when I say they blinked, we have to go back to the Evergrande crisis. And if you remember, everyone was worried, is Evergrande going to be the Lehman of China? And what I think the Chinese government attempted to do was isolate Evergrande and then insulate the rest of the sector. But, the entire sector was trading at 5-10 cents. The sector was frozen. This is 25% plus of the GDP. So when they blink, I talk about, the massive amount of support, and one could even argue was the equivalent of a Chinese TARP program in order to support this sector.
Robert, what was impressive about you guys last year is what you chose not to be invested in. You went into the year without Russia. without exposure to that story. It wasn't like you had to race to cut exposure. You did it ahead of time. Can you tell me whether that was your best decision, what not to own, as opposed to what to own?
Look, and I think that takes you into the whole debate about, passive versus active management. And, I think over the past, 5-10 years, passive and beta has been easier to hold on to. But your example of Russia and Ukraine is a great example. I think it exposed people to losses, I think maybe 800 basis points of loss, just because it was in the index. And one of the problems of when something's in the index, it's risky not to own it, right? I hear managers say all the time, well, we have no risk because we're flat to the index. It reminds me when we started Gramercy back in the late 90s, and the JP Morgan Emerging Market Bond Index had an 18% weighting to Argentina. It wasn't, whether you owned it or didn't own it was a huge thing. So yeah, I think 2022 was a big part about not only what you owned, but what you didn't own.
Well, let's build on that. There is this phrase that you've used, this paradigm of non-payment in high yield, sovereign high yield. Robert, where do you think that's going to show up this year?
Yeah, Mohammed and I and the team in 2020, as we huddled up around COVID and all the implications, one of the themes that we identified was this notion of a paradigm of non-payment, and that there would be certain sovereigns that would have adverse effects because of COVID, and we've seen this great balance sheet transfer, resource transfer from sovereign balance sheets to corporate balance sheets. And we thought that would play out, quite frankly, earlier, 20 and 21. And it did to a bit in Argentina and Ecuador and what have you. But remember, there was a tremendous amount of global liquidity in 20 and 21 as well. So what we saw in 2022 is this paradigm of non-payment starting to play out, places like Sri Lanka and Ghana and what have you, and these stressed sovereign balance sheets not having access to the capital markets. So that's created actual default, and securities have gone down and traded like default. So we believe 2023 could be the year where investing in the recovery of this paradigm of non-payment could be important.
This is fascinating stuff, deeply thoughtful. Enjoyed the outlook too. Robert, let's do this again soon. Robert Koenigsberger there of Gramercy Funds. Equities up just a little bit, much more so on the Nasdaq. Let's get you the trading diary. Coming up, existing home sales at the top of the hour. Fed Governor Chris Waller speaking at 1 p.m. Eastern, followed by President Biden at 2 p.m. Look out next week, US PMIs on Tuesday, along with earnings from Microsoft, followed by Tesla on Wednesday. Fourth quarter GDP on Thursday, and another read of the US economy to round out the week. From New York, that's it for this week. Enjoy the weekend. From New York, this was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, January 20th. Here are the top market stories that we're following for you at this hour. Avoiding the 1970s. Larry Summers warned central banks not to go soft on inflation. We're going to get the read from Esther George, president of the Kansas City Fed, an exclusive exit interview. And tech braces for more pain. Google cuts 6% of its workforce as big tech is forced to trim more fat. That stock up over 4%. And brace for options. Almost 180 million options contracts are expiring today. That's the highest in a decade for a January. Equities fizzle this week after a stellar start to the year. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And guys, speaking of the data and then equities, it's been a really difficult week for the data, a really murky picture, making direction for equities a bit more complicated.
As our question, I think, articulated perfectly yesterday. Bad news is bad news, good news is bad news. I think it's really hard to judge what is happening here. I think the market is confused. I think everybody's pretty confused right now. The data continue to flow onto the Bloomberg terminal, and the latest numbers we get, Alex, existing home sales, I can't see the month-on-month number yet. I wait for the update on that. But actually, the data look a little bit better than anticipated. So the prior month, remember, negative 7.7%, revised a little lower. But this month, negative 1.5%. So the rate of change shifts, and that was versus an expected number of negative 3.4. So again, just confusing data. The data's all over the place at the moment, but I keep coming back to claims telling us that the labour market is strong. If you base everything from there, I think you've got a pretty good handle on what is happening.
Yeah, just for some superlatives for that. Existing home sales, they hit the lowest since 2010 and dropped the most since 2008. But again, that's kind of what the Fed might want to actually see happen. Yep. In terms of then how you read the equity market, and I mentioned options expiration earlier, this is going to be really difficult. Volume is super, super huge right now. You have a lot of a lot of calls into option expiration. Yep. What do you do then when you had a week like this? You got to put on more puts then for February? How do you deal with it?
Well, given the start we've had to the year, I think a lot of people were kind of on the wrong side of it, therefore have been chasing the market, therefore have probably been doing that with options, therefore they're probably long on the call side of the fence. That's going to make this very, very difficult.
Yeah, exactly. And there's a quick check then on the markets. You get the S&P still up by about 0.3%. NASDAQ 100 up 0.7, obviously helped by Google as well, Guy. The Dow, though, a little bit weaker. And I bring that up because transports have been behaving really well along with home builders. And if you were looking for a breakout, that's where we're seeing it versus the economic data, which is a bit more lumpy.
Okay, let me just give you one stat. The Bloomberg survey of where the S&P, SXXP is going to finish the year, 452. That's where we're trading today.
Yeah, fair enough. Bond market here, we're looking at pretty much the whole bond market is on offer. You have 10-year yields up by about 6 basis points. We want to send it over here now to Bloomberg and Kansas City Fed President Esther George, an exclusive exit interview as we look on inflation.
Hello, and thank you very much. We'd like to welcome everybody who is watching on Bloomberg Television, listening on Bloomberg Radio around the world to Kansas City, where Esther George is joining me. She's the president for a few more days of the Kansas City Fed, and as we mentioned, it is her sort of exit interview, and we thank you for having us. I'd like to start with the data we just got and data we saw earlier this week, and that existing home sales are falling. Finally, prices fell for existing home sales and for the median price, but we saw retail sales come in weak. We saw the ISMs come in weak. Is the economy unfolding as you thought it would?
Well, welcome, Mike, to Kansas City. Yes, I think the economy is responding to some of the forecast and some of the work that the Federal Reserve is doing to try to bring better balance between supply and demand. And of course, as rates have gone up, it always hits most directly, I think, real estate markets, and in particular, we've seen that in housing, where mortgage rates have doubled. So these trends, I think, are to be expected in that sector in particular.
Well, a lot of your colleagues have said they're paying more attention to current rate measures than to the data that comes out in the CPI and PCE price measures because it's lagged. why don't you just sort of ignore the idea of the core rate? Because everybody comes out and says, well, inflation's too high, you look at the core rate. But you know that's influenced by housing, and if you take that out, it seems inflation's coming down faster than you thought.
I think it's encouraging to see, because we've seen this in the goods sector of the economy. That inflation has been coming down. I think when we look at the housing component of that, we can see toward this year that should be, again, coming off some of its highs. I think right now, for me, the focus has really been on the services sector and the inflation pressures that we continue to see there. So the direction, I think, is a good one. Inflation is still well above the Fed's target, and so to be true to that price stability mandate, it looks like we'll have to be a little more patient to see if we're on the right trend and going to be there more convincingly to that 2% target.
Well, what would it take to convince you?
So I think, again, looking to the component of the market right now where we continue to see a lot of pressure. Labor markets are very tight. I hear that when I go around the region talking to our contacts there. So I think the pressures we see in the services sector look likely to continue. We know that spending is continuing. People are still traveling a lot and taking advantage of that. So I think that would be a component where I'd want to see some progress before having more confidence that we're seeing inflation come down.
Fed was slow to see inflation rising as fast as it did. Could you be too slow to see inflation falling? Do you think it could fall faster than you anticipate?
It's one of the things we have to be very mindful of. So there are lags with this policy instrument. It transmits pretty quickly to financial conditions, and of course we've seen that. But we also know that there's lag, so it's in the pipeline coming. It's one of the reasons that last month I supported that downshift to a 50 basis point increase, because I think it will be important to begin to watch very carefully what signs are we seeing in the data, but also listening to our contacts in the region and understanding, are we beginning to see the kind of progress we need to see.
Well, you had a reputation as an uber hawk, somebody who was always very on top of inflation, and yet you were the first one to warn about the lags and the fact that the Fed had to be careful. Was that because of something you were hearing from your constituents out here?
Well, in this most current tightening cycle, I think we were beginning to approach this at the same time that we were taking some dramatic moves to reduce the balance sheet. And so you want to make sure that as you start off on that path of tightening, that you're communicating well and that you are not going to be more disruptive with that. I think we're in a good place today, again, being very clear about the commitment to getting back to 2%, some of this aggressive tightening. But we are reaching a point, I think, where it will be important to start looking around corners, listening more carefully for where some of those shifts are going to take place.
Have you been surprised by the strength of the labor market and the fact that you've raised rates 450 basis points and the unemployment rate's gone down?
So it is. This is a very tight labor market, and I think unusually so in this sense. We've seen 3.5% unemployment before, but when we look at the people that are engaging in that workforce, we are still down in terms of participation compared to where we were in 2019. We see a number of job openings for every available worker. And so in that sense, all the indicators show how tight the labor market is. And again, when I go out and talk to people, it's their number one concern, find people to come to work. So I think on the supply side of the economy, we're seeing some binding constraints there that are making it more complicated, if you will, to see inflation come down in a very convincing manner.
Raise unemployment by a full percentage point, and it's about 1.5 million people who lose their jobs. Do you think there's a path to avoid that now? Do you think that maybe this is a different enough dynamic that unemployment doesn't have to rise significantly?
I think when you look so far, so spending has held up. What I'd really be looking for is to see, are some of those job openings going to come down? Will we see some of those vacancies removed as we see this imbalance begin to be addressed? So I think this scenario of can there be a soft landing is one we would all want to see, and there are some possibilities for that. There's still a lot of money sitting in the checking accounts of households. They may hang on to that. That will make the job easier. To the extent that moves out, that may create more persistent need to tighten. But I think you have to wait and see how that unfolds.
Why do you think Wall Street doesn't believe you when you say you're going to hold rates for a long period and you're going to do whatever's necessary?
Well, I don't know that I'm the right person to speak on behalf of Wall Street. I will tell you, we can have different horizons and different lenses through which we look at this issue. I hear a lot about recession probabilities, a lot of focus on what's going to be that peak rate. I think for me and my colleagues, the focus is really on getting back to price stability. And that is really a very singular focus right now, and thinking about what it takes to have that policy be sufficiently restrictive, not overly restrictive, to get to that point of a 2% long-run inflation goal.
Well, let's stipulate you do that. What do we see in the economy once this cycle is over? Do we go back to the new normal of low rates and low inflation? Do we go to an old normal? Do we go to a new normal? What kind of economy do you expect?
I think it'll be different. I don't have that crystal ball to really see what will it be. But one of the things I think has been extraordinary to watch during this time, you had a lot of demand come in. So the support from fiscal stimulus, from monetary policy produced a lot of demand. And yet we are looking at still pretty low growth. And we're looking at binding constraints on supply, and in particular looking at the labor market. And I think there, one of the things that will be interesting to watch unfold, I hope research continues to look at this, is we were focused for the last 2 decades really on, is it a demand deficiency in our economy? I think this time we've seen that there are some constraints on the supply side. And what structural the nature of those might be, I think is going to be worth keeping an eye on. And I think longer term will have implications for monetary policy's role.
How has the structure of your district's economy changed in your time at the Fed, and how does that affect monetary policy?
Well, so many things have changed over my time at the Fed. Still, this part of the country heavily focused on ag and energy. The ag sector, you've seen a lot of consolidation. Farms are bigger. The way they go about doing their work is different. Technology has played a different role. We see transportation and logistics in this part of the country, very important factors in how we understand what's going on in the region. So I suspect many of those trends are going to continue, and as those structures in the economy change, of course, the Federal Reserve, as it carries out its mission, has to be mindful of that. And we're well positioned to do that, both by boots on the ground as we talk to people, as well as the team of people that do our research and think about what's going on.
When you look at the world of politics, you see complaints from places in the South and the Midwest that policymaking is decided on the coasts. And I'm wondering if there's any kind of feeling that the Kansas City district doesn't get represented, not by you, not well, but doesn't the feelings of people here aren't as reflected in monetary policy, on Wall Street, in economic policy as other parts of the country.
So it is true. You have an economy that has different aspects to it across the country. The coast, where urban areas versus rural. One of the things that I think is so important about the design of the Federal Reserve is that it does give line of sight to the policy deliberations for people in the 10th Federal Reserve District. So you can go from Kansas all the way to the Rocky Mountain West and engage with people who understand their voice is heard. And those perspectives do go back to the FOMC when we talk about the nature of policy. So we don't have the kind of surgical instruments that let us affect those. But I think being very open to understand that the different regions experience the economy differently, people experience the economy differently, is important for people to have trust in the work that the Federal Reserve is doing. And I think that design is so important to how that unfolds.
You hear a lot from people on Wall Street, this Fed always gets things wrong. You've been with the Fed for a very long time, but even prior to becoming president of the Kansas City Fed. What do you think the biggest mistake in policy that the Fed has made over those decades that you've been here?
Well, I'm sure people could point to a number of things. I think for me, Mike, when I look at the long-run focus of this institution, our mandate is one of long-run decision-making, of deliberation around that, of ensuring stability in the economy. And I think those are hard many times as the economy is shifting, as you see different business cycles come through, to get timed exactly right. One of the things I think, though, that the Federal Reserve is very committed to is learning from those experiences and learning what happened in that. We've done that, for example, from the 2008 and 9 period, when financial stability became such an important aspect of how the Federal Reserve would be able to achieve its mandates. And you see today a lot more attention on thinking about what role does financial stability play in terms of our ability to conduct the kind of monetary policy we need to. So I think those kinds of attentions to past episodes are important.
One big issue in economics has been the treatment of women, and your bank is one of the best in terms of diversity in the Federal Reserve System. Is that a conscious effort? Is that because you're a woman, you think?
I think it's a conscious effort. It's a conscious effort because, again, my own experiences are the breadth of diversity that you bring to problem solving is so important. And that happens around the FOMC table. It happens in conferences. It happens here when we hire people to come to work and carry out the mission of the Fed. And I think the broader your lens, the more you extend the opportunity for that talent to come in, whether it's at the Jackson Hole Symposium, whether it's at the FOMC table, it begins to widen the perspectives that come to bear on some very important policy issues. And I've always thought that was important, and I think it will continue to be important for this institution.
You mentioned the Jackson Hole Conference. This is Davos week, and the Davos Conference has changed tremendously over the years as TV has come in, as it's become a bigger and bigger thing. You let TV come to the Jackson Hole Conference. Are you worried that it takes over? I mean, a lot of people who are hoping to be invited want to know what the future of the conference is going to be like.
Well, I think you know, Mike, we have been very transparent about what goes on at Jackson Hole. That's been a commitment from the start. This is a conference that is focused on central bank issues where we bring academics, we bring policymakers from around the world to talk about those issues. So a commitment to being transparent has always been there. That's served us well. It informs the public about what goes on at the conference. During the pandemic, of course, when we couldn't gather in person, we began to find other ways to do it, as many organizations did, and created that opportunity to do that. So we'll keep that commitment to transparency, I suspect, for Jackson Holes to come.
Esther George, thank you much. One 5-second question here. Chiefs or Jaguars?
Well, I'm in Kansas City. We think it's going to be a great lineup, and I'm rooting for the Chiefs.
Esther George, thank you very much. Her final interview as president of the Kansas City Federal Reserve. We'll send it back to you.
Thank you very much indeed. Mike McKee, Kansas City Fed President. Esther George with Bloomberg's Mike McKee. We wish her well and thank her for her service. Coming up, big tech, big cuts. Google, the latest company to slash its workforce. 12,000 jobs are set to go. Details to follow. The startup is next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Elon Musk could testify as soon as today in the Tesla fraud trial in San Francisco. Shareholders contend that Musk's 2018 tweets about a plan to take the electric car maker private amounted to lies that cost them big losses. Musk's lawyers argue that he was sincere. Bloomberg's learned that Saudi Arabia's sovereign wealth fund considered buying Formula One motor racing, but a potential deal faltered in the early stages last year when its owner, Liberty Media, was not interested in selling. The Saudi fund valued Formula One at well above $20 billion. Genesis has become the latest crypto firm to collapse in the wake of the FTX exchange's swift downfall. The cryptocurrency lender filed for Chapter 11 bankruptcy protection in New York. Its top 50 claims amount to about $3.4 billion. And more job losses. Wayfair is cutting about 1,750 jobs, or 10% of its workforce. The company announced the reductions would include around 18% of its corporate employees. The initiative will amount to more than $1.4 billion in annualized cost actions. It's expected to help Wayfair break even on an adjusted earnings before interest, tax, depreciation and amortization basis earlier in 2023 as the first step towards positive free cash flow. Google is joining the list of tech companies drastically scaling back operations. Its parent Alphabet says it will cut about 12,000 jobs. That's more than 6% of its global workforce. Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. And that is your latest Business Flash. Guy?
Ritika, thank you very much indeed. Let us pick up on that story. 22 minutes past 7 on the West Coast. Time for the startup. We cover the stories that are influential in the Bay Area and beyond. This is Silicon Valley, of course, starts this morning. Joining us now in London, Alex Webb of Bloomberg Quick Take. I want to start with the Google story. Google, quintessential growth stock. Can you be a growth stock and cut jobs at this kind of scale?
I wonder if it's a question actually the management is asking themselves, right? Because ultimately their growth is set to slow. And you've seen the share price come down massively. Obviously, a lot of that is to do with interest rates and, you know, tech stocks just generally being a bit less appealing on that basis. But they're sort of trying perhaps to show investors that they can increase profitability without needing to grow the top line. So if that is, you know, the thought process possible, here, it would suggest that maybe there is a slight pivot away from that growth trajectory. The other way of looking at it is that, you know, to be maybe cynical, you could say, well, maybe it's a rainy day. They're using that as cover to cut some of the chaff so that when things start to perk up again, which they may well do, they're in a far better situation than they might otherwise have been.
If I just look at Class A shares here for Alphabet, we're looking at an estimated PE about 20 times. Is 20 times enough to justify a growth stock that may no longer be a growth stock?
Well, I think 20 times is in line broadly with the rest, with the market as a whole, with the S&P 500. I think I'm right in saying. So, you know, do you then say that actually a lot of the sizable stocks in the market are growth stocks? Like, I don't know, this might be a question more for an equity strategist than for me. It is like clearly discount to Apple at a premium to Facebook. Is Facebook a growth stock? Well, it's not really growing much at the moment, but it may well do in a good few years' time if it gets the metaverse right. These are sort of, we're seeing huge changes in the tech industry at the moment. The question which I don't think anybody quite knows the answer to yet is, are these changes permanent?
Let's switch the channels and talk about Netflix. Management changes there. And actually things are working. The ad model looks like it's actually going to be delivering. Has Netflix come through the hole and is now on its way out again?
Well, actually, to this question, if we almost take it back to this question about growth stocks, it's like one of the things with growth stocks is that there's sort of an assumption, I'm massively oversimplifying, but there's an assumption that at a certain point you can flip the switch and just generate cash flow when you need to, right? Yep. And that is the question with Netflix is that actually possible? Because one of the things that is driving subscriber growth is investing in content, right? You need new content, not just to attract new subscribers, but to retain the existing ones. So there's always going to be a relatively high level of cash spend. the actual profitability missed some of the estimates, even though the user growth was higher. Now, the question about the advertising business is that a way of offsetting that cash spend and yet still retaining those subscribers? And what Netflix has been trying to say today, or has been saying today, is that, or yesterday I should say, when they announced the numbers, that like the people who've been signing up to the ad-supported tier, they are not cannibalizing the existing high-level subscribers. Now, time will tell whether that's actually the case. The other crucial point is they might have been attracting people with that tier. In order to make proper money from them, they have to have a well-functioning advertising business. You know, they could potentially be making upwards of $15 per month per user, with half of that coming from ads. They've got to build that model out. It's not there yet.
Real quick, how much can they actively make per user to justify the kind of spend? You mentioned hopefully 15. Do they get to 20, 25?
So Hulu does $7 a month in advertising revenue from each of its subscribers. I think, you know, if you can get that to 13, then you'd be looking at $20 a month.
I mean, that's something. All right, Alex, really appreciate it. Thanks a lot, Alex. We have a quick take, Bloomberg Quick Take joining us there. All right, coming up, we're going to turn to the broader markets. S&P up by about 0.4%, NASDAQ 100 up by 1%. Are the highs of the year's in? We're going to break that down with Ethan Devitt, Moneta Chief Investment Officer, joining us. This is Bloomberg. We're about an hour into the U.S. trading session. We're looking at, another rally underway here. NASDAQ 100 outperforming up by about 1%. Kelly Lyons tracking those moves for us. Kelly.
Yeah, Alex, we're trying to end the week on a positive note, but unless something remarkable happens, this likely is still going to be a down week for U.S. stocks because we're coming off of a 3-day losing streak on the S&P 500. So a 0.6% move higher today isn't enough to unwind the damage we have already seen over the course of this week. And as you said, the NASDAQ 100 is outperforming up more than 1%. Interesting to see that happening as we have bond yields moving higher. The 10-year Treasury yield up about 6 basis points to 3.45, but likely it's really more about the individual stories today than that broader macro cross-asset picture, like Netflix up 7% after blowing it out of the water on subscriber additions in the quarter. They reported last night 7.7 million compared to an estimate of just 4.5 million. So investors taking that news quite well. Also, technically bad news that is being taken well by the market is job cut announcements we have gotten today. Wayfair, the online home retailer, cutting 10% of its workforce, but getting a really nice reward in the market for that. That stock is up more than 15%. Investors clearly liking those cost-cutting efforts, and that effort is underway at Alphabet as well. It announcing it's going to cut 6% of its workforce, about 12,000 people. That stock is up 5%, and the CEO, Sundar Pichai, basically saying, I take full responsibility. We overhired. They're now facing a very different economic environment, much like tech companies across the board. On the subject of that economic environment, let's talk about the economic data we've gotten today as well in the form of existing home sales. Technically, it was an upside surprise in that they weren't down as much as expected, but still declining for an 11th month in a row and actually hitting the lowest level since 2010. Of course, the housing market, one area of the economy in which you are seeing the deterioration showing up. Still not really showing up in a material way in the labor market, though, and does it have to for the Federal Reserve? It raises the question of where Fed policy goes from here. We have seen a chorus of Fed speakers talking up the idea that they are going to do smaller hikes, like 25 basis points next month. That is something Patrick Harker echoed, saying that the days of the Fed hiking 75 basis points are over, but still he expects they will raise rates a few more times this year. So now the question becomes, Guy, is it so much about the journey anymore, or is it about the destination and how long we stay there? That is what this market is contending with.
Yeah, the market has basically based the whole idea on the idea that we are going to see a decent-sized recession. The yield curve has pointed to that, but now maybe we don't get it because the labor market is holding up. Soft landing. Esther George talking about that possibility. Kaylee, thank you very much indeed. Let's turn to our question of the day. Where does that leave us? Are the highs in for the year? Joining us now, Ethan Devitt, Monitor's Chief Investment Officer. Ethan, I was looking through the Bloomberg a little bit earlier on, looking for some data on this. If I take a look at European equities, and we surveyed, I think, 19 strategists for what they saw the end of the year number being for the Stock 600. They had that number at 452. We are trading at 451.79 right now. Are the highs for the year in?
Well, all I can say is I sincerely hope not. We're sort of 18 days into the year. Certainly, we would really hope we haven't seen the highs, if anything. And that was a great summary just done by your colleague. We're seeing the repeat of that good news is bad news and bad news is good news conundrum that really took us all the way through 2022. What has been a surprise, and I saw this in none of the 16 outlooks that I combed through at the beginning of the year to see where we were going in terms of Fed policy, inflation, recession, etc. None of those outlooks, I think, accurately call this outperformance we're seeing so far of non-US stocks. Nobody calls the swift reversal we were going to see in this dollar direction. And that is the biggest surprise so far I've seen in 2023.
So does this even put strategists in a really awkward position? Like they need to keep now upgrading to kind of chase the rally that we've seen? Then how does earnings wind up factoring into something like this?
It's really interesting. One of the messages I definitely saw loud and clear last year was the telegraphing of bad news well in advance. So that's why we're not seeing those kind of negative earnings surprises that we thought we would. We see companies are pretty clever. They're taking a leaf out of the Fed's book in terms of really getting expectations managed, and then they can surprise on the upside. So that's what we're seeing around earnings. As to what we can see, I think there's still significantly more upside again when it comes to Europe. We saw that this mild winter that's not great for the ski resorts is actually quite good in terms of energy demand and energy pricing. That's probably a surprise that nobody saw coming. So when that surprise is better than we expected, it is time to go back to the drawing board on those models and perhaps revise the numbers up.
Ethan, the yield curve is telling me that we are heading for a really bad recession. Is the yield curve wrong?
The yield curve probably has got ahead of itself, yes, because if we looked across those outlooks, a really bad recession was really only an outlier case. Some cases actually had no recession in the forecast. Most had a soft landing, and then we're hoping that what we're seeing is that we were generally muddled through, that their employment was still strong, that was going to salvage the consumer. The consumer would still be spending on those kind of defensive names, on those kind of non-discretionary items like healthcare, like consumer staples. And ultimately, I think that, yes, the yield curve probably is ahead of itself, but remember, it's still getting that hawkish sentiment from the Fed, so it would probably be churlish to go anywhere else at this point in terms of the yield curve. For an investor standpoint, it's a great time to be sitting in cash, a great time to be sitting in biding time in terms of dry powder as to where to enter next. There's going to be more fallout in some of those lagging sectors such as real estate, for sure.
What's also confusing to me, and to Guy's point, is that you look at some of the breakouts, home builders, transportation. Semis kind of made a run for it, but didn't really make it. Like, these sectors could actually break out. Those sectors don't make sense if the bond market is pricing in something binary, like 5% and stay there, or a bunch of cuts because we're looking at a deep recession.
They don't make sense, but again, it gets to how much this was a question of the day, I'm sure, a few weeks ago, how much of the bad news is already in the price. When it came to home builders, we saw a very sort of slackening of demand, stark rises in mortgage rates for that new home buyer. And I would suggest that much of that was already in the price, was overdone. And now if we look at even the way Netflix numbers have increased, I suggest we're getting closer to a normalization now. We're coming out of the post-COVID froth. We've seen the post-COVID decline, and now we're getting close to a normalization, not only in home builders and other areas, but also in areas such as general consumer demand staples.
Some of this feels early cycle. Let's talk about the earnings season, because we're about to get into the thick of it. Can we have an earnings recession without a recession even?
I would suggest that what we're actually going to see is more positive news on the market side, even while the economy doesn't look so great. We're going to continue to see bankruptcies, store closures, consumers feeling the pinch on inflation. I actually expect that the market, so the earnings side, is going to exceed that. Even just looking at those numbers you saw today from Google and from Alphabet and Netflix. If we look at those, and Wayfair, if we look at those numbers, they really don't make any sense in light of where the direction of those businesses are going. But again, I expect that the earnings picture will be rosier than before. Because of the managing expectations, they will be exceeding on the earnings side. And we may actually have quite a kind of a dampened mood, I'd say, on the economy side that won't match what we see in markets.
Right, and that's such a good point, because guys been talking about early cycle, and it feels like the economy for sure is late cycle, yes, but the market feels early cycle, and that's a really weird dynamic to parse out. So based on that, we're also seeing a ton of money go into EM and go into Europe as well. Does that continue?
That has actually really surprised me. Obviously, a little bit of performance chasing. Because in EM, just remember, even during the course of this year, we were undermining the case for investing in Russia. We were asking whether China was investable because of some of the regulatory changes there, asking whether there had been a fundamental change in what we were seeing in terms of the outlook for China. Could we believe any numbers? This was the macro backdrop we were talking about. So why would we see this uptick in emerging market flows so suddenly? I'm not sure I believe it. I think it's maybe relative to the outflows that we saw. I still see a real waning of conviction in emerging markets. Those old habits have died hard. Investors are a little scarred from that. I do see, however, a resurgence in investing in Europe. A lot of Europe is very old economy, defensive. It names some of the pharmaceutical names, some of the industrial names. There was no reason for them to sell off. They may have sold off because of that energy crisis, which has now been mitigated somewhat. So I do see better demand for those non-US investing, but still on the emerging market side, I'd be surprised if we see a strong rally and inflow into that sector.
Hence the whole early cycle combo. Ethan, wonderful stuff. Ethan Devitt, Moneta Chief Investment Officer. Thank you so very much. All right, coming up, back to the economic data at the top of the hour. Talk about trying to get all the data through here. Existing home sales falling the most in December since 2008, but it was still a little better than expected. We're going to get the breakdown here with Zillow Chief Economist Skylar Olson kind of next. This is Bloomberg.